Well, good afternoon and welcome everyone to Nedbank's Group Interim Results broadcast. It's a great privilege for me to host the Group's results for the first time as Chief Executive. The agenda of our presentation today, as shown on the left, will start with me providing an overview of the Group's performance in the first half of 2024, a reflection on the operating environment and the outcomes we achieved on our strategic growth drivers. I'll then hand over to Mfundo, our COO, who will provide an update on the progress we're making on our strategy. And Mike, our CFO, will then follow with an analysis of the Group's financial performance, including that of our respective frontline clusters. I'll then return to close out the presentation with the outlook for the remainder of the year and our medium and long-term targets. You'll notice some slides are marked additional info in the top right corner, and these are slides of additional information and insights which we'll not speak to directly today and which are available in our results booklet. Starting with the overview, the operating environment during the first 6 months of 2024 remained challenging. Economic activity was weak, impacted by high interest rates, persistent inflation, and general uncertainty ahead of the South African national elections. This meant corporates remained cautious and consumers' finances were strained. However, a peaceful and fair South African election outcome and the swift formation of a government of national unity have created space for cautious optimism. On the strategy side, our delivery continues to show results, and we've seen good outcomes across our various strategic value unlocks with a renewed focus on enhanced execution in support of ongoing value creation. Mfundo will unpack this in more detail shortly. Despite the difficult operating environment, the Group produced a strong financial performance, with diluted headline earnings per share up 12%, and our ROE, which is usually seasonally lower in the first half of the year, increasing to 15%. This performance was driven by lower impairments, good NIR growth, and targeted expense management, underpinned by a very strong balance sheet. Shareholders should also be pleased with the 11.5% increase in the interim dividend to 971 cents per share. The seamless transition from Mike Brown to myself was well planned and well executed. I've got an excellent working relationship with the board and the leadership teams, which has enabled us to get on with business very smoothly. I've adopted Nedbank's performance targets over the medium term as my own, and our focus as a team is heightened on achieving them. I'm extremely comfortable with the strong foundations that Nedbank has built, including capital and liquidity, and an improving financial performance, as well as the Group's strong and vibrant culture, its focus on transformation, leading ESG credentials, and significant technology investments. And we'll continue to build on these strong foundations as we evolve and refresh our strategy. Next, we reflect a bit on the operating environment that provides important context in which our financial results should be assessed. GDP growth in the first half of the year has been muted, and corporates remain cautious ahead of the national elections. This was evident in slower wholesale advances growth, except for pockets of growth in areas such as renewable energy finance. On the positive side, the country's electricity supply stabilized in the first half of the year, with Eskom suspending load shedding towards the end of March and improving its energy availability factor as shown in the graph on the bottom left. The South African election outcome and formation of a government of national unity stimulated positive market sentiment, including lower bond yields, stabilization in foreign bond and equity sales, strong equity markets, and a stronger rand. Spreads on credit default swaps, as shown in the next slide, improved markedly and are trending towards levels when South Africa's sovereign credit ratings were at investment grade. We remain cautiously optimistic around the potential benefits associated with an effective GNU and expect better macroeconomic conditions in the second half of 2024. On the consumer front, finances remained under pressure as real household incomes contracted and job prospects remained muted. Transactional income growth continued to experience pressure due to high interest rates and persistent inflation, albeit trending down as shown in the top two graphs. Debt service costs remained high, highlighting that the strain on consumer finances is still elevated, and as a result we have seen continued slowdown in household credit growth. Our strategy outlines our focus and the actions required to achieve our medium and long-term targets. And our strategy is well positioned for a natural refresh in an evolutionary manner as we build on the strong foundations that have been put in place. I'll unpack the progress we've made on our strategic value drivers, and Mfundo will talk to the group's strategic value unlocks that are enabled by our world-class technology platform and our employees as our most important asset. Execution has been steady, with further opportunities to improve our growth and productivity initiatives while we maintain very strong risk and capital management metrics. And starting on the left, while we were disappointed with the slow pace of advances growth, we recognize the impact the difficult macro environment has had on the demand for credit. On the upside, RBB grew main bank clients by 7%, and NAR increased their client base by 9%. Digital metrics also continued to grow strongly, with app volumes, the key retail channel, up 13%. In Nedbank Wealth, assets under management increased by 5% to 463 billion rand, and trading NIR in CIB increased by 18%. And lastly, in June, we acquired Eqstra to strengthen our position in the fleet management market. From a productivity perspective, good collection efforts in RBB and the resolution of stage 3 loans in CIB supported a good impairment outcome. Our TOM 2.0 program has reached cumulative cost benefits of 2.6 billion rand, above the 2.5 billion rand target we set. Our focus on extracting further value from our technology investments has resulted in the launch of TOM 2.1, which Mfundo will unpack further as we aim to achieve a lower cost-income ratio over the medium and long term. On the far right, our key risk and capital management metrics reflect a very strong balance sheet. Our CET1 ratio at 13.3% remained well above the top end of our board target range of 12%. Liquidity metrics such as LCR and NSFR remained strong, significantly exceeding the minimum regulatory requirements of 100%. Under credit, our CLR improved to 104 basis points, almost back to within our through the cycle target range, and the group's total impairment coverage ratio remains strong at 3.51%. And lastly, in response to the recent announcement by Transnet and the SIU relating to historic interest rate swap transactions, and as stated in our SENS announcement of 26th of July, I'd like to reiterate the following. Firstly, we remain satisfied that Nedbank's internal governance procedures were followed in respect of these swaps. Secondly, that there is no evidence of any Nedbank employee being dishonest, corrupt, or in collusion. Thirdly, the claim that Nedbank profited by more than 2.7 billion rand is incorrect, as the sales margin we earned was market-related and amounted to less than 43 million rand. The swaps were commercially sound, and the ROE earned by Nedbank was fair, reasonable, and appropriate at 15.5% over the life of the transactions. And finally, we will strongly defend litigation against us, and we will pursue counterclaims against Transnet and others. I'll hand over to Mfundo now, who will talk to our strategy in more detail.
Thank you, Jason, and good afternoon, everyone. In my section today, I will demonstrate how our focus on strategic execution through our strategic value unlocks is creating value and delivering results. Starting with our technology strategy, at the end of June 2024, our managed evolution IT build reached 95% completion, and the program is still aiming for full completion by the end of the year, materially within scope, time, and budget. As we finalize this program, we are now shifting our focus to 4 key areas: completing managed evolution, rationalizing and simplifying our product set, commercializing data, and harmonizing or consolidating systems across the group, including our subsidiaries. Under managed evolution, In the last stretch to the end of the year, we are refactoring and modernizing our core banking systems and completing the digitization of the two remaining client onboarding and servicing journeys, being home loans and vehicle finance. We have started rationalizing our product range with a focus on making banking easier and more affordable for our clients. To this end, more than 2.2 million MyGold transactional accounts have been opened or converted on our new core banking platform. We will continue our focus on reducing the number of transactional products by around 60%, the number of investment products by around 80%, and the number of lending products by a percentage still to be determined. From a data commercialization perspective, we have established a dedicated data and analytics team to spearhead our strategy in this space. The progress we have made on our technology journey is foundational for seamless integration and fast adoption of AI capabilities. And currently, we are investigating more than 50 use cases that will support revenue uplift, cost optimization, and improve lending decisions. Lastly, our Nedbank Africa region IT systems convergence is underway, with completion set for the end of 2026. Multiple benefits have been derived from our technology platform and market-leading digital capabilities. As we have noted in prior periods, starting on the left, digital onboarding is seamless for both individual and juristic clients, and most of our services have been automated and digitized, enabling our clients to self-service. From a product sales perspective, 64% of all retail sales are now done digitally, and we are making great progress towards our target of more than 75%. As shown on the additional information slide, Money app transactional volumes and values grew by 13% and 19% respectively. The launch of PayShop, a real-time interbank payment offering aimed at reducing the high use of cash in South Africa, has seen steady growth with Nedbank's share of volumes around 23%. Benefits for Nedbank are shown on the right of the slide. From a revenue perspective, we continue to unlock higher levels of cross-sell, deliver strong growth in main banked clients, and increase the contribution from value-added services and beyond banking solutions such as AVU. From an operational efficiency perspective, through our target operating model programs, we have saved more than 4.5 billion rand by adopting digital practices, reducing floor space, and reducing headcount, mainly through natural attrition. Reflecting on our progress relating to strategic portfolio tilt, from a lending and deposit-taking perspective, we are pleased to have gained traction in areas that create value. We have increased market share across home loans, vehicle finance, overdrafts, and retail deposits. While the market share of wholesale term lending decreased, we have a strong deal pipeline in place that will support growth into the second half of 2024 and beyond. In commercial mortgages, where we have a leading market position, we have been more selective, with market share strong at 35.4%. Given ongoing risks in the environment, we have deliberately slowed growth in unsecured lending, and as a result, we reported a market share decline in personal loans. From a retail deposit market share perspective, we were pleased with an increase in market share to 16.7%, while more work is required in growing share in commercial deposits. As Jason mentioned, our target operating model 2.0 program that focused on optimizing the shape of our infrastructure, shifting our RBB organizational structure to be more client-centered, and optimizing our shared services functions, realized benefits of 2.6 billion rand at the end of June. To illustrate the progress we have made through Project Imagine, branch floor space has decreased by 60,000 square meters since 2020. And through our strategy of consolidating our own campus buildings, we have saved more than 201,000 square meters since 2016. At the end of June 2024, our total group permanent headcount declined by a net of 17, after absorbing an additional 276 new employees as a result of the acquisition of Equestro. Our ongoing focus on extracting value from our technology investments has resulted in the launch of TOM 2.1. We expect further run rate benefits from TOM 2.0 to be unlocked in the period ahead, and TOM 2.1 will additionally focus on extracting benefits from the commercialization of data and analytics capabilities, optimizing key processes, and payment ecosystem modernization. We are in the process of finalizing associated revenue and cost benefits to be realized over the medium term, and more detail will be communicated as part of our 2024 full year results. Fulfilling the purpose of using our financial expertise to do good is best demonstrated through our delivery against the UN Sustainable Development Goals and the progress we have made on our sustainable development finance ambitions. As at end of June 2024, we provided sustainable development finance support of 154 billion rand, representing 17% of the group's gross loans and advances. This represents good progress from the 13% in 2021, when we set our ambition of reaching 20% by the end of 2025. This financing is supported by some of the initiatives we highlight on the right of the slide, including 16 billion rand of sustainable finance across multiple sustainable development goals for CIB clients, 28 billion rand for farmers and agriculture, and 23 billion rand in support of SMEs. A key highlight of the period was the conclusion of a 4.5 billion rand term loan facility to support the supply of 75 million cubic meters of water to the Mukolo Crocodile River water augmentation project in the Lipalale area. Unpacking renewable energy under SDG 7, the graph on the left shows that we have made good progress in closing a number of renewable energy deals, mostly in private power generation. Exposures increased by 20% to 36 billion rand since December, and limits increased by 27% to 58 billion rand, highlighting the very strong pipelines we have in place. We will continue to convert these pipelines in 2024 and deliver strong growth in our renewable energy portfolio, as evident in 11 billion rand of further drawdowns expected by CIB in the second half of the year. Lastly, as in prior presentations, I will reflect on a few ESG highlights. In March, we became the first South African bank to disclose financed emissions targets for our thermal coal, oil and gas, and power generation portfolios, and simultaneously, the first SA bank to publish a nature position statement. These actions build on our leadership in climate change and reaffirm our commitment to carbon neutrality by 2050. We maintained our Level 1 broad-based Black economic empowerment status for the 6th year in a row, and this was supported by improving our African, colored, and Indian representation to 83% of total employees. We also recruited more than 3,600 youth employment service participants, bringing the total first-time job opportunities we have provided to the youth to more than 13,500 as we continue to make an impact on South African youth, their families, and communities. Finally, from an ESG ratings perspective, we continue to rank at the top end of our local and global peer group across multiple ratings, as shown on the left-hand side of this slide. I now hand over to Mike to take us through a review of the group's financial performance.
Thank you, Mfundu, and good afternoon, everyone. As highlighted by Jason, the operating environment has been challenging, but as Mfundu demonstrated, we've made good strides in implementing our strategy. This meant that revenue growth for the whole sector has been under pressure from the difficult macroeconomic environment, while at Nedbank, impairments were well managed despite the ongoing pressure on consumers. Against this backdrop, all group profitability metrics continue to improve, evident in relatively strong headline earnings growth of 8%, strong DHEPS growth of 12%, and an improved ROE of 15%. The faster growth in DHEPS when compared to headline earnings is linked to the 5 billion rand share buyback we executed in 2023. Our credit loss ratio pleasingly decreased by 17 basis points to 104 basis points and was almost back to within the group's through-the-cycle target range of 60 to 100 basis points, in line with the guidance we provided. While balance sheet growth was muted with advances and deposit growth below mid-single digits, key balance sheet metrics remain strong, evident in our liquidity and capital ratios. The key drivers of shareholder value creation all showed positive momentum, with our ROE, which is seasonally low in the first half of the year, improving to 15%, now equal to the group's cost of equity. Following our relatively strong earnings growth and capital and liquidity positions, we declared an interim dividend of 971 cents per share that increased by 11.5% at the top end of our payout ratio. Net asset value per share of 230 rand and 97 cents increased by 2% year on year and was impacted by negative foreign currency translation reserve movements relating to accounting for our share of these movements in ETI and our non-South African businesses. Reflecting on the primary drivers of the 8% growth in headline earnings, net interest income increased by 2% and non-interest revenue by 7%, while associate income declined by 26%, given the non-repeat of the reversal of the 175 million rand estimate we provided for our share of the impact of the ETI-related Ghanaian sovereign domestic debt restructure program in the first half of 2023. Impairments decreased by 12%, while expenses were well managed, increasing by 8%. Reflecting on the balance sheet, gross banking advances growth was muted. In RBB, the 5% growth in both average and actual advances was slower than the prior period. Growth was primarily driven by gradual home loan market share gains and good growth in vehicle finance, but we have been deliberately cautious in the unsecured lending market given elevated risk. CIB's actual banking advances increased by 5%. The increase was driven by growth in term lending, including key growth sectors such as renewable energy, and strong deal pipelines are in place for the remainder of the year and into 2025. Commercial property loans and advances grew slower as clients delayed activity due to the South African election uncertainty and the high interest rate environment. average CIB advances grew by only 1% after a slow first quarter. On the opposing side of the balance sheet, deposits increased by 3%. Due to the high interest rate environment, clients continued to term out short-dated cash into longer-dated deposits. As a result, current and savings accounts, along with cash management deposits, decreased by 4% and 14% respectively. In contrast, call and term deposits increased by 7%. Fixed deposits decreased by 3% as consumers utilized borrowings to meet debt service costs, and NCDs decreased by 5% as slower loans and advances growth reduced the need for marginal deposits. Turning to the income statement, NII increased by 2% as average interest-earning banking assets growth of 3% was offset by slight NIM contraction as we had expected. The 5 basis point decline in NIM to 413 basis points was primarily driven by asset pricing pressure given increased levels of competition for good quality assets, liability pricing pressure, and the introduction of deposit insurance. This was partially offset by the positive endowment mix impact due to net capital balances growing faster than interest-earning assets, and endowment pricing benefits due to the run rate impact of higher interest rates. NIR growth was good at 7%. Commission and fees income increased by 8%, supported by strong growth in CIB on the back of deal closures, while growth in RBB was more moderate. Continued strong growth in value-added services, higher maintenance fees, and growth in both card issuing and acquiring volumes was offset by slower transactional activity given the difficult macroeconomic environment. Trading income increased strongly by 14% due to good client flows and strong performances in equities and debt securities. Insurance income declined by 9%, adversely impacted by lower traditional bancassurance volumes, further investment in product and channel initiatives, and lower shareholder returns. This decline masked strong underlying premium growth in the cover suite and stable claims ratios. Lastly, other NIR was slightly higher than the prior year, and this was driven by equity investment income that increased by 14%, driven by higher realization gains from dividends, interest, and distributions, positive fair value adjustments, including foreign currency and interest rate gains in the CIB banking book, as well as gains relating to the group's hedge-accounted portfolios, and these gains were offset with a base effect of 399 million rand foreign currency gains on US dollar capital in Zimbabwe, net of the net monetary loss realized in the prior period that did not repeat. Excluding the Zimbabwean base effect and the Eqstra acquisition for June, non-interest revenue growth was 9.5%. Turning to impairments, the group's impairment charge decreased by 12% to 4.7 billion rand. The decrease was primarily driven by a 15% decrease in RBB impairments on the back of focused management interventions in respect of collections and improved loan origination as consumers adjusted to a more stable macroeconomic environment over the past 12 months. Impairments in CIB, Wealth, and NAR were well managed. The group's central provision remained at 150 million rand, and total overlays increased to 1.6 billion rand from 1.1 billion rand in December in anticipation of model regrounds in RBB in the second half of the year. The group's credit loss ratio decreased to 104 basis points, just above the through-the-cycle target range of 60 to 100 basis points, in line with guidance. The CIB credit loss ratio at 19 basis points was within the bottom half of its through-the-cycle target range of 15 to 45 basis points, reflecting the cluster's high-quality portfolio. The credit loss ratio in RBB at 183 basis points was slightly above its through-the-cycle target range of 120 to 175 basis points, but declined from the 226 basis points reported in the prior period. Pleasingly, credit loss ratios across all RBB products and segments improved from the levels reported in the first half of last year, with the exception of vehicle finance, given strain experienced in our small taxi portfolio and lower asset realization values at auctions and this is receiving significant focus. Wealth reported a credit loss ratio of 17 basis points below its through-the-cycle target range, while NAR reported a credit loss ratio of 91 basis points within its through-the-cycle target range, driven by improved collections and subdued loan growth. The group's total ECL coverage at 3.51% remains strong and reflects prudent provisioning in the current economic environment. The Stage 1 coverage ratio remains steady at 0.67%, and Stage 2 coverage decreased slightly to 6.8% due to stage migrations. Stage 3 coverage increased to 38.2% as RBB loans with higher coverage increased by 1 billion rand, and Stage 3 loans in CIB declined by 8 billion rand since December, after the resolution of large single-name exposures as we had expected. Shifting our focus to costs, expenses increased by just below 8.5%. Excluding the Eqstra acquisition, expense growth was 7.9%, reflecting tight cost control. The 9% increase in salaries, wages, and other employee costs reflect the impacts of average annual salary increases of 6%, the use of additional contractors to assist in the completion of managed devolution, and additional costs to retain talent and scarce skills. Incentives increased by 7%, aligned to higher levels of profitability and vesting expectations. Computer processing costs increased by 7% and reflect the impact of the rand's devaluation on foreign currency IT contracts, ongoing investment in technology, and higher digital volumes. Accommodation costs decreased by 3% as we continue to benefit from our real estate optimisation initiatives and the impact of lower generator-related costs due to lower levels of load shedding. Other costs include the impact of increased levels of travel and a higher intake of YES participants in 2024. Reflecting on ETI, associate income relating to our 21% shareholding decreased by 32%, primarily given the non-repeat of the base effect of the reversal of the 175 million in the first half of last year. The carrying value of our investment in ETI is now immaterial at approximately 600 million rand, as the increase in associate income was offset by large negative foreign currency translation reserve movements during the period. Our share of the market value of ETI listed on the Nigerian Stock Exchange is now approximately 1.4 billion rand. Turning to capital, our CET1 ratio at 13.3% remains well above the top end of the board-approved target range of 11 to 12%, positioning us well for growth, complementary bolt-on acquisitions such as Eqstra, sustainable dividend payments at attractive payout ratios, and to absorb the possible Basel III PCN countercyclical buffer expected by the end of 2025. Given our strong capital position, we have obtained all necessary approvals to conduct a further share buyback, which we will execute depending on market conditions. Closing with the clusters, CIB produced a strong set of results with headline earnings growth of 13% and its ROE increasing to almost 21%. Earnings growth was primarily driven by an 18% increase in non-interest revenue, supported by commission and fees on deal closures and strong growth in trading income. NII was flat as 1% average advances growth was offset by slight margin compression, while expenses increased by 11%, driven by higher incentive costs aligned with performance. CIB's medium and long-term focus remains on reducing its cost-to-income ratio to below 44% through a focus on top-line revenue growth while maintaining an ROE above 19%. Retail and business banking showed a good recovery with headline earnings growth of 24% and a higher ROE of 14.6%, driven by the strong improvement in impairments. NII increased by 3%, driven by average loan growth of 5%, partially offset by a slight decrease in NIM due to lower client margins. NIR increased by 6% or 4% when we exclude the Eqstra acquisition. This growth was mainly driven by strong growth in value-added services, higher maintenance fees, and growth in card issuing and card acquiring volumes, partially offset by slower transactional activity. Expenses were well managed, increasing by just 6.5% or 5.5% when excluding Eqstra. RBB's medium and long-term focus continues to be on reducing its cost-to-income ratio to below 57% through revenue growth and productivity improvements, while increasing its ROE to above 20%. Nedbank Wealth's headline earnings decreased by 18%, but its ROE remained healthy at close to 25%. NII increased by 3%, positively impacted by the benefit of higher local and international interest rates, offset by the exit of the corporate e-gaming sector. NIR decreased by 2% due to the decline in insurance income, as I mentioned earlier. This was partially offset by growth in assets under management. Credit impairments increased off a low base, and expenses were well controlled, increasing by 5%, notwithstanding the investment in people, brand and digital and data initiatives, as well as the impacts from higher inflation and exchange rates. Of note was the impact of the higher tax charges in the international businesses due to the implementation of the minimum 15% OECD Pillar 2 global tax rate. Nedbank Wealth's medium and long-term focus continues to be on reducing its cost-to-income ratio through faster revenue growth in areas such as insurance and maintaining an ROE at least 10% above the group's cost of equity. In the Nedbank Africa regions, headline earnings decreased by 36% and its ROE declined to 18.2%, largely as a result of base effects. Similarly, the SADC operations headline earnings decreased by 41% and its ROE decreased to 7.3%. Excluding the base effect of Zimbabwe, headline earnings were up 65%. NII growth of 8% was driven by improved margins, while NIR decreased by 13% and impairments by a pleasing 24%. Headline earnings relating to our associate investment ETI were down 32% on the prior period, largely due to the base effect. The underlying performance of ETI remained robust, with its core regions continuing to show a strong performance, with ROEs of above 25%, while Ecobank Nigeria remains a focus to improve. In the medium and longer term, the cluster remains focused on reducing its SADC cost-to-income ratio by growing the franchise and achieving scale, and as a result, improve its ROE to above cost of equity. In closing, I am pleased with our performance for the first half and am looking forward to ongoing momentum in the second half as we continue to make progress towards our medium-term targets. Thank you. I'll now hand back to Jason.
Well, thanks, Mark. In closing, I'll provide our outlook for the period ahead, starting with our latest economic forecasts, which informs our financial guidance to the market. As noted earlier, we're cautiously optimistic around the potential benefits associated with the South African GNU. Our base case assumes better macroeconomic conditions in the second half of 2024 and into the medium and long term. In this context, we forecast South Africa's GDP to increase by 0.9% in 2024, improving to just below 2% by 2027. Our upside scenario, should the GNU make good progress, suggests that GDP growth could exceed 2% from next year on. Average inflation is expected to ease further and average 4.9% in 2024, and then progress to the midpoint of the SARB's 3 to 6% target range. As a result, we expect the prime lending rate to be cut by 25 basis points from September onwards, and for rates to cumulatively reduce by 50 basis points, taking the prime rate to 11.25% by the end of 2024. We then forecast a further 75 basis point cuts of 25 basis points each in 2025, taking prime to 10.5%, from where it will then remain stable for the next few years. Credit extension is forecast to remain slow for the rest of 2024, before increasing to above 6% in 2025, supported by a decline in domestic interest rates and improving execution of infrastructure and renewable energy investments. the potential upside scenario is for at least 1% additional growth on top of our base case. And although it's difficult to forecast, the rand is expected to strengthen but remain vulnerable to global developments. Our favorable scenario could see the rand at or below 17 versus the dollar from 2025. Turning to our guidance for 2024, NII growth is now expected to remain below mid-single digits, driven by moderate growth in advances, albeit stronger in half 2 24 than in the first half of the year, and our NIM is expected to continue to contract slightly due to marginally lower endowment income. Our credit loss ratio is still expected to move back to within our target range for the full year, due to the steady progress we've made in RBB and having resolved legacy CIB Stage 3 loans. NIR growth is now expected to be around upper single digits, revised from above mid-single digits, given the impact of the Eqstra acquisition. In addition, we expect ongoing benefits from deal flow in CIB, higher levels of cross-sell, main bank client gains, and strong growth in value-added services in RBB, while insurance income is expected to show an improved performance in the second half of the year. Our focus on tight expense management remains in place, and we expect growth of upper single digits, mainly driven by the impact of the Eqstra acquisition. Associate income at full year is expected to be slightly lower than 2023. And capital ratios are expected to remain well above board ranges, and our dividend, subject to board approval, at the top end of the payout ratio of around 57%, while we look for market opportunities to execute further share buybacks. The environment for banks and our clients could become more positive should the GNU be effective and enable an environment that delivers higher levels of GDP growth. The South African national election was fair and peaceful, with continuity in key government positions and suitable changes in other ministries, setting the tone for economic policy execution, enhanced governance, and greater accountability. Higher levels of GDP growth are attainable should the GNU accelerate structural reform and achieve meaningful fiscal consolidation. This will go a long way towards reducing South Africa's risk premium and unlock efficiencies for the private sector, setting the stage for faster economic growth and, as a result, addressing social challenges such as unemployment and inequality. The potential upside for Nedbank would be evident in stronger credit and transactional growth, as well as reduced strain on clients as inflation and interest rates decline. Lastly, on the back of an improving operating environment, we continue to aspire to deliver ongoing improvements in ROE to increase shareholder value, as we show in more detail on the additional information slide. Our strong financial performance in half 1 24, together with the progress we've made in executing on our strategy and better economic prospects, gives us confidence in making progress towards our stretched medium-term targets, and in particular, our aim to increase our ROE to 17% by 2025 and above 18% in the long term. Thanks very much, and we'll now proceed to your questions and answers.